Here we are.
Here we are. Hi, Robert. Welcome to Al Insights. This is a podcast by Momentum Finance, and it's targeted towards first-time founders and startup entrepreneurs. And we're excited to have you here today.
Great, Tim. I'm happy to be here myself.
I thought would be, we've known each other for about 3 years now, and I know that you spend a lot of time looking at startups, and I thought that would be a really interesting place to go with the conversation. But first, I'd like to start with some of your background and let us appreciate your experience and all the places you've been. And with that, I'd like to kind of start, where did you grow up?
Sure. Well, my background is very broad. I'll put it that way. Started in California, and I've been in engineering, operations, program management, finance. I've covered, all of these disciplines. Gone into the executive suite. I've been the COO and CFO. Worked for large Fortune 500 companies. Worked for nonprofits, small companies, a little bit of everything. And I'm probably one of the few people you've talked to that have worked in so many different industries. I was in the oil and gas industry. That's where I started with Mobil Oil. I worked for Starbucks, so in the coffee industry. I went through the .com era, and I can't even remember the companies I worked at because most of them don't even exist. Telecommunications, T-Mobile. Worked in the aerospace industry. And then I did some consulting on the side, and then I got into tech. And I've been in tech for the last 10 to 12 years, which is probably the area of the industry that I enjoy the most.
What were you doing what was your engineering background?
So mechanical. I went to school at Cal Poly, San Luis Obispo in California, and went to school for Mobil Oil right out of school. And I was there. I worked for Mobil for 15 years, and you're probably going to think, man, this guy's about 100 years old when I go through all the companies. But I was in California, I was in Denver, New York City, DC, in the last five years with Mobil in Singapore, and did engineering, moved more into operations. While I worked for him, I went back to school at night, got my MBA, so got more into the finance. In Singapore, we had a big refinery there, but we had a trading office, which was a lot of fun because we could, trade cargoes, buy cargoes of crude and sell product. And then we had a refinery there, so if we couldn't sell the crude, we could always drop it into the refinery, and then we supplied all our affiliates all along Asia, as far north as Japan, South Korea, all the way down to New Zealand, Australia. And that was, you think Mobil Oil is a huge company, and it is, but we had a lot of autonomy there, and it was before the merger with Exxon. So, we could do a lot as long as we stayed profitable and kept ourselves clean. And it was funny because Exxon, or Esso, also had an office there. And they really couldn't do anything without checking back at headquarters, which was, I think, Florence Park in New Jersey, which was a 12-hour difference. So, distressed cargo would come up, and they would have to check, wait for home office to get back to them, and we'd pick it up, before they could get approval. So it's just kind of ironic. Now they're combined. Anyway, so I was there, and then decided to leave Mobil, moved to Seattle, and went to work for Starbucks in their finance department. We had a group called Profit Improvement, where we would look for opportunities within Starbucks to either increase revenue or cut expenses, mostly expense reduction. And that was, again, a lot of fun because we would find opportunities mostly from talking to the various employees, and then we would get the employee to kind of sponsor it. So it wasn't like, oh, this is our idea, and you told it to us, but we're going to take the credit. We would say, that's a great idea. We want you to get up in front of senior leadership, and we'd hold their hand and say, this is how the process, how you figure out how much money we're going to save, and then they present to senior leadership, and they get the credit, and then Starbucks would save money.
That's great. Are there any examples? Because I think that's a level of innovation and kind of entrepreneurship within the corporation. That's very interesting. Is there anything memorable that happened?
Oh, I focused a lot on supply chain, HR. I think there's so many things. I'll just pick one. Supersized coffee bags. Most coffee bags come in, and it almost looks like a bag of cement,
right?
Pounds or whatever. And of course, we said, well, if we can get the suppliers to put that in a supersized bag that would just fit on a pallet, and then you don't have to load the pallet, multiple bags at a time. You just got a huge supersized bag, and then ship it to wherever we're roasting, and then it was just a big savings in supply chain costs. So that's an example we do. We switched to, now I'm trying to remember. We looked at PTO on ways of saving and changing the structure on PTO, combining sick leave and days off. And that's more of a balance sheet type.
Right, the accruals of that time.
Yeah.
Yep.
So like I said, there were hundreds of projects, but what was fun is it really focused on the people and getting the people excited about it. Because usually when you think, cost containment, that means, I'm going to lose my job. Well, at that time, Starbucks was growing, and so we said there's no risk of losing a job, even if it meant this is going to make your job more efficient, so you won't have to spend as much time on it. There's a million other things you can do to fill that time.
Right. You've lived really all over the world. What brought you to Park City? Like, what did that journey look like?
Oh, I was in Seattle for 20 years and worked for a lot of different companies there. And my wife and I, we loved Seattle. It's got great place, great people, but we love to ski, we love the outdoors, we love the mountain bike. So we said, well, let's pick a place that really, does what, we can do all the things we like to do. And then at that time I was the CFO at a tech company, and most of the leadership were remote, so I could live anywhere. And then we said, this was pre-pandemic, this was in 2019, so it's like, okay, we got to be close to an airport, but so, looked at Park City, we looked at in Montana, I got family in Bozeman, looked at Denver, I lived in Denver for a while, in Boulder, and then, Santa Fe, Telluride, those kind of places, and, Park City, one, you're so close to the airport, you've got, 5 or 6 ski areas to pick from. It's got the world's best snow, in the universe, and then the mountain biking is phenomenal. So it was almost a no-brainer. We drove through on our way to a wedding in Boulder, and I said, well, let's stop and take a look around. And we looked at a few houses, and we had our criteria, and I don't want to go too far off on it, but it can't be, this is what Robert wants and not what Lisa wants. It's like, we got to be on the same page. So, we listed all, what's the criteria, and then let's stack rank it, and let's get on the same page. And so eventually we were there. Then we can, start looking at places, and that's the analytical side of me, and we've never looked back. And fortunate we moved pre-pandemic before the cost of housing went way up. I mean, it was expensive to begin with, but now it's really expensive.
Yeah, everybody wanted to exit the cities after a few years ago.
Yeah, so we love it. Never looked back.
And those are your 2 favorite sports that I pick up on? It's what, mountain biking and skiing?
Yeah, I would say those are the 2 favorite. I did get sucked into the pickleball vortex. So I'll probably play pickleball 2-3 times a week. And that's a lot of fun. And then I'm still working part-time for the tech company. I'm no longer the CFO. I'm on their board, and I advise the CFO and the COO. So that takes up a portion of my time, and then I got involved with the Park City Angels, and got into the screening group. When I say it's a group, it's more or less just two of us that are doing it, and then we reach out to people who've got domain expertise in certain areas when needed. Mostly life sciences, because that is way outside of what I know. And that's been a lot of fun, and that takes up a bit of time, but it's just fascinating because we look at probably 60 companies a month screening, and from everything from, like I said, life science probably takes up 20%, tech, software takes up another 20%, and then the other 60 is just all over the board. And it's so interesting to look at what companies, what are the ideas, what are the things they're offering, what do the teams look like, is it going to work? And 60 is a lot, so we have to narrow it down to 15, and then those 15, my buddy and I, Aiden and I, we call those companies and we talk to them for probably 15, 20 minutes, and there's only so much you can get out of Gust and the pitch deck, and
right.
And then we narrow that down to 5, and that goes to a screening meeting, a screening committee. So there's probably maybe 10, 12 of us on that, and then they'll actually pitch, and then we discuss and narrow that down to 3, and those 3 will go to the general meeting, the monthly general meeting. So every month we go from 60 down to 15, down to 5, down to 3. Takes a bit of time, but it's fascinating, and it's also having that many, we can really get the cream of the crop that we eventually put in front of the general members.
That's incredible. And your pattern recognition for trying to identify both opportunities that are attractive to the angels, as well as identifying founders that you suspect have maybe an outsized probability for success. Your pattern recognition has probably been pretty refined over these last few years, because I suspect you haven't dug deeply, but you've seen 1,000 pitches, I suspect. Before we get into kind of the analytical ways that you judge that first cut, trying to get from 60 to 15, what have you identified about the founders? Are there personality traits? Are there ways of engagement? Are there any insights that you've garnered about the humans kind of behind these ideas?
Yes, I mean, it's the team, the founders is one of the things we look at, and as I talk about this, there are no blockers, nothing to say, oh, if you don't have this, you can't, Park City Angels or any angel group is not going to be interested in it, but it's something you just need to be aware of. But the team is important. It's nice to have more than just one founder, a co-founder, and then, having domain expertise, not only in the business area they're working in, but preferably startups. If they've taken companies from startup to and grew them and sold them, that's a benefit. So, domain expertise, startup expertise, or experience, having a good culture is important. Well, what's a good culture? They're coachable. They listen. They realize they don't know everything, and that's important. And it's especially on the startups where maybe there is just one founder, and that's what's one of the things that angel groups or Park City Angels will offer is let's say it's a smaller startup. A couple of months ago, we had a company come through. One guy, he was developing energy bars, and he still had a full-time job, but this guy, man, he could sell dirt for the price of gold. I just think of somebody that could sell probably all the used cars on a lot within a day. I mean, he just had everything, but he didn't really know about forecasting and all the things that most people would, putting together a plan. And so we said, wow, this guy is good. We would want to invest in him, but we also want to invest our time and effort to help mentor him and bring him along. And he was all about, he was like, man, you guys know a lot more than me. I want to learn. And so having a team that is open to input from others is very helpful.
Well, that's got to be really reassuring to entrepreneurs to hear that if you're, we jokingly say a one-man band, but your passion is so great, and the ability to have taken those first steps to get, product market fit or get that product out, and that you feel that people want that product, to find an angel group that's willing to roll up their sleeves and say, well, let's help you build out kind of the operational side, or at least the knowledge base that's going to need to be developed to build that company, to really get it to a point where you're generating enough revenue and maybe you raise enough money that you can hire an operations person and you can get a customer success or get shipping people, the team that you need to wrap around yourself so that it grows beyond, one person's passion that, that really created a lot of excitement from the potential angel community.
Mm-hmm. Yeah, and I just want to mention that when we see teams of, let's say it's a husband, wife, brother, sister, again, I want to be cautious to say, well, that's a deal breaker, but it does send up a little bit of a red flag. And so if there are entrepreneurs out there that's a husband, wife, as long as they've got something as a backup, preferably another co-founder or advisors, that if for whatever reason, family issues get involved, you don't want that to happen. So we always coach those type and say, well, you're a great team now, but let's say that the wife is really the domain expert and the husband is helping out. Well, could the wife ever get to the point where it's like, I need to fire my husband? That makes it a little bit challenging. But if they've got other co-founders that can bring in their expertise, that helps get over that hurdle.
That's really good advice. I mean, I think we've looked at all startups are incredibly challenging, and the amount of work, the amount of hats you have to wear, and then to add, that additional dynamic is really tricky. So, in my experience, there's really a broad path of acceptance for the Park City Angels, whether it's a solo founder that's really figured something out and they need that initial support to help them build that into a business, to maybe a health sciences company that needs, a lot of money, many, many millions to really even proof of concept, to even get to some of the phases of testing, and then software somewhere in the middle where maybe it doesn't take that much money to build your alpha or your beta product and get it out and see if there's fit in the marketplace or a desire to use the product. Do you see kind of an upper and lower band? I mean, obviously the lower band is, one person with a good idea is definitely going to get time and attention if they've got that secret sauce, whatever that is. Is there kind of an upper band, the way you look at it when you're screening?
Because we have close to, Park City Angels, we have close to 100 members, we try to work in, there are angel investors who want to invest in that one guy startup company. And then we have others that are probably a little more risk averse, that says, all right, this company, they've got a strong team, they've already got a product out there, they're getting traction, and they are doing one more raise before they go to a priced round, and those are less risky. And then you've got And then there's like life science. Okay, again, I usually try to pull in experts that are in the life science area because they don't have traction. They don't, it's all pre-FDA approved, whatever they're working on, and so you can't say, well, they've already got traction out there. So it's a little bit of everything to satisfy the diverse group that we have. Saying that, I would say there's a tendency to be more on the deals that are less risky.
Okay.
And maybe that's because I'm more conservative.
Now, when you say less risky, to de-risk a deal, are you looking at $500,000, $1 million in revenue? Are you looking at some amount of money raised, some amount of team in place? What are the kinds of things that de-risk a deal in your mind?
Yeah, good question. And it's all relative because you could say, okay, well, if I have a concept only and I may have an MVP or minimum viable product, but I have no customers yet, okay, if that's angel investing.
Right.
But that is more risky than, okay, let's say I've got some sort of software technology and I've already got, traction with multiple customers and the revenue, again, it could be, it varies, but let's say they're 100,000 up to $1 million plus 12 months, reoccurring revenue. That takes out some of the risk. If they've got potentially VCs already involved, if they've got a lead that is involved, if the round is, let's say they're raising $1 million and they've got 800,000 already committed versus, again, somebody that it's like, well, you are the first group that I've talked to. It takes.
So you do agree that there's a higher perceived risk, if not real risk, being first in and around versus being last in. It's kind of intuitive because last in, you've got a bunch of other people that ostensibly have done hard work and have come to the decision to invest.
Right. There's more risk if you get in first, but the valuation is lower. But if you've got traction and you come in at a later date, the risk will go down, but then the valuation goes up. And so maybe your return is going to be, I don't know, maybe you're looking at a 30x and now it's a 5x.
Right.
We had a company come through last month that was pretty far along and they just needed almost a bridge loan before they went to their Series A, and they had, I think it was $5 million in annual reoccurring revenue. They had lots of customers, and so that was, and probably the return is more of a 8x,
Right.
And that it just depends on what your comfort zone is. Again, I'm more conservative, so that's more my line, and how much dry powder you have and what you want to invest in. And
do you see? Well, I guess to state, the industry I think has seen over let's take the last 3 years as kind of the period of discussion. It's 10 to 40% decrease in valuations. It appears less of a decrease at the smaller rounds and a larger decrease in the bigger rounds. So let's say seed to Series C, kind of that 10 to 40% is kind of the data that I'm seeing on the decrease in valuations. Are you seeing that when you look at just in the last 12, 18 months of the applications? Are you seeing valuations come down?
I would say we pretty much see what everybody else is seeing. The valuations have come down a little bit.
Okay.
I think valuations are very hard to, put your thumb on. It's some companies, we ask, it's like, well, where did you come up with that valuation? And some companies, they're like, well, we looked at other companies. they don't really know. You know,
It's really more of an art
Mhm.
in the early days of a startup, because a lot of my counsel to founder clients is basically you have to back into numbers that make sense for you. So, you know, maybe an industry average is a price round is going to be about 30% dilution, but you need to take into account maybe the safes that have been raised prior to that. So you back into, you know, I'm pretty sure I need $3 million. I only want 15% dilution. Well, that kind of puts you at about a $15 million valuation. And that's part of backing into something, but it's not so out of parts, because again, you don't have a multiple to look at, because most of these things are not enough revenue to really have the analytical foundation for that to be the determining factor.
Right, and sometimes they'll base it on what their projections are, and you know, whatever the projection is, it's probably wrong.
Well, we know they're made up.
Yeah, I mean, anything that's more than 3 years out is a crapshoot anyway. But then again, you need to have stuff. The entrepreneur needs to give you something that is realistic. You know, sometimes we'll see stuff with this huge hockey stick, and they had zero revenue in 23, and they said, oh, they're going to have $1 million in 24. Well, we're already halfway through 2024, and then they're going to have, you know, 10 million and 100 million the following years. And I'm just like, well, how far along are you on this year? Let's look at that. Well, we've got a lot of stuff in the pipeline. All right, just be honest with me. Tell me
Right.
what is really, you really expect. And that's another point, is you need to be brutally honest. The entrepreneurs, if there's something they say or don't say that we later catch, you know, sometimes it's, well, we don't have competitors, or we have one competitor. And then it goes to due diligence, and we find that they've got 4 or 5 competitors. They're true competitors. That, you know, it just, now the integrity of the person is in question, and we don't want to invest in anybody that would question their integrity.
Yeah, I think that really comes full circle with one of the parts that you want to explain about the integrity is you want to be the first person to mention something that's potentially problematic, get in front of that, and then hopefully have a good defense on why that's the case.
Mm-hmm.
Because that's just, you know, when you're building relationships, that you want to be able to trust what that person says. And also, as an angel, we know to discount the projections. It was like, well, I assume they're not going to be as productive and optimistic as they've been presented to us, so we're going to have some kind of discount.
Mm-hmm.
But whether you do a 25, 50, or 75% discount has a lot to do with the credibility of the founder.
Right.
Trying to understand where that's going to work. I think in Gust, one part of the application process, we want people to upload their pitch deck, upload some financials, and I think there's an opportunity for some kind of a little video commercial. Is anyone using that video function right now?
Yes, it's in there, but to be honest, we don't take the time to look at that. Mostly because we've got to look at 60 companies, and
That could be 6 hours of video to work on.
yeah. So we'll spend anywhere from 30 seconds to 10 minutes on each company in Gust.
Okay.
You know, if we go into Gust and the company hasn't put in any of the information, and they've got a 3-page pitch deck, that's game over. You know, I don't have the time to go back to them and say, oh, you got to fill it out, and you know, I just have to move on to the next one.
So the quality of that first impression, obviously, it's mission critical. Again, without getting into too much detail, what do you feel is like the minimum viable product? I know that we've talked about this in depth of kind of, you know, a score sheet of the things that you want to see so that you can kind of force rank the quality of a presentation even before you have the subjective opinion. Well, what is a minimum viable product that you want to see in a pitch deck and you want to see in the financials? I think that's two different questions. But I mean, for that pitch deck, what do you need to see to just at least give them the time of day to have that 50-minute conversation on the phone?
Right. So, pitch decks, 15 slides plus or minus. What's the business problem? What are they addressing? Maybe a slide on their team, their product, a list of who their advisors are, what they're asking for, why, where is it, what are some of the milestones they're going to meet. I don't know, information such as that in a short amount of time, it's at a high level, but it provides that basic information. The financials, it varies by company. Again, life science, they aren't going to have any financials because
you at least have to have an estimate of how much cash you're going to have to spend to get to something.
Yes. So there, it's more important to say, okay, this is what's going to bring us to get us through the first set of clinical trials, let's say, and then we're going to have another raise that's going to get us to the next step, and here's where you expect FDA approval, and what is our exit? Well, usually, when they get close to FDA approval, again, I'm generalizing, they're going to have a lot of the big companies have an interest in potentially buy their IP, but they might want to go and actually go to market on it. So, having that laid out, if they don't have revenue, if they do, again, what are they going to do? What are the milestones to get to that next level? Will they need another raise? Are they expecting that to be a priced round? If it's a safe or a convertible note, what are some of the valuations they might set on that? What are the caps? That kind of information.
Hi, Robert. Welcome back. Thanks for rejoining me on Owl Insights. Apologies for the technical difficulties, but we're going to pick up where we left off and answer some of these interesting questions.
Great. Thanks, Tim. Looking forward to finishing the last half.
Thank you. So I think where we were talking about really some of the more tactical details around the angel investments and your sense of what's happening in this space over the last year or two. And one of the questions I was on the top of my mind is, has there been any change in your mind from an investor standpoint around safes and convertible notes?
Yes, there seems to be a lot more safes than convertible notes or a priced round. As you're aware, safes are simpler, couple of pages. And from an investor's perspective, we'd much rather have a priced round versus a safe, and convertible note is kind of a happy medium. Safes you don't have as much leverage, I guess, as much your rights are not as, you don't have the same rights that you have as if it's the priced round. So we often see founders asking for a safe, and if we're early in the process, one of the investors that is coming in sooner rather than later, or the round hasn't been, we're one of the first ones into the round, we can negotiate that, and sometimes they're open to either a convertible note. Best case is it's a priced round. But to answer your question, yes, there have been a higher percentage of safes than the other two. And sometimes I think from a founder's perspective, always the safe is preferred. And so that's kind of the default.
Sure. So one of the things that I've noticed is there tend to be two flavors of safe. There's one with a discount to the next price round. And secondarily, there's a discount in combination with a valuation cap. Are you seeing any movement in that, or a bias towards one form or the other?
I've seen both, Tim. I've seen, and we tend to see a discount for when there is a priced round, and often there is a cap if they have an idea of what the valuation is. But
Right.
valuation is another question of, well, what is the valuation? So there's sometimes they're set a little bit too high. Um, but I would say safe you see both. I think my preference is to have a cap and a discount so you get the best of both worlds.
I agree. Next question is there's some congratulations on Park City Angels being named one of the better angel groups in the
Yeah,
country. I saw that article come out a couple weeks ago, I
we're
guess.
we're in the top 13, so that was interesting.
Yeah,
Um,
lucky 13. Um,
we weren't the 13th, but
one of the things that's unique about Park City Angels is they have what I affectionately call a sidecar. So we just wrapped up Park City Angels Fund One, and we've now implemented Fund Two. And my understanding is what happens with the fund is it invests if a certain number of members invest a certain number of aggregate investment. Can you tell us a little bit about maybe the backstory and the existing Park City Angel Fund Two and what how people trigger it?
sure. So our fund two, we have about 1.2 million in the fund. It's closed now. And the criteria for that, for those funds to be invested, every month we have, we have a general meeting, we have at least 3 companies pitch. And if any one of those companies gets 4 or more Park City Angel investors, and the cumulative investment of those 4 is 150,000 or greater. So, you could have one person invest 25,000, another one's got 50, and anyway, the cumulative is 150. The fund will kick in another 100,000. So the benefit of the fund is, as you're aware, angel investing is you have to make a lot of shots at the goal in order before you hit a win. So rule of thumb is you got to invest in 10 to 15, probably closer to 15. And if you're investing 25,000 a pop, that can get up to a pretty big chunk of change. Well, investing 25,000 into the fund, that will get spread over 10 to 12 companies. So now you've got your investments spread across many companies, so that if you invest in 15 companies, 8 to 10 of them are probably going to go belly up. There'll be a couple where you'll get your money back, and then there'll be 2 to 3 that you'll have a huge return that covers the cost of all the other investments. So it's a good way to get in. We have a lot of I'd say new people, or people who are new to angel investing in Park City Angels. And plus, if you don't have that much dry powder, it's a good way to spread your funds.
Thank you. And I believe when we see a lot of deals coming through here, we don't always have the opportunity to push back on structure. I mean, they might be a C corp or they might be an LLC. My understanding is there's a limitation for the fund to invest. Is that accurate?
Yes, we require them to be a C corp. I cannot think of a scenario where we'd allow an LLC, primarily for tax reasons and having to chase K1. So, the Park City Angels who are running the fund, it's voluntary to be chasing K1s for 10 to 12 companies, and filing taxes would be a challenge. So we require C corps. And most companies are C corps, and companies that pitch to us that are LLCs, and we advise that if they want to be considered for the fund, they've got to be a C corp. They quite often will switch to a C corp in order to meet that criteria.
Thank you. And So to switch gears and talk about the financials, what both of us have a background in kind of the accounting financial side of the um, domain experience on working with companies. What level of sophistication, like we're assuming this is kind of pre-seed and seed stage investment opportunities. What level of sophistication do you expect from the founders when
Uh,
they're presenting on Gust?
that's a good question. And of course, it varies depending on the industry, the company, what stage they're at. Um, but I would say the best case scenario is a company has already proven traction, both in financials and customer count, and they've got a little bit of history of revenue and their expenses. Uh, and then their net income. And so we look at the high level of what history and then their forecast. Um, expenses broken down uh, by line item, not so much initially. Certainly, if we gets to the point of due diligence, we'll look at that. But if they come in with no financials, um, that's a red flag, and I'm gonna come back to that. If they come in with financials where, okay, they had zero revenue in 23, but now they're projecting 2 million in 24, and we're already 8 months into the year, they better have some traction. And then they say, oh, there's going to be a huge hockey stick in 25. That's a bit of a red flag. Uh, and I'll come back to the companies with no financials. It's typically life science companies that are, they're at the preclinical testing or clinical stage, and they're going to have to go through several more rounds before they actually commercialize their product or equipment or drug or whatever they're working on. And so that we don't expect to have financials in that case, but we do expect to have a cash flow and identify how long they can go currently, how long they can go on the current raise, when they think they're going to have the next raise, what kind of raise is that going to be? Is it going to be another safe convertible note, or is it going to be a series raise? Those kind of things.
And do you expect financials to extend to break even so you understand that path, or is it 3 years, 5 years? Do you have a preference?
Of course, it's nice to see a break even sooner rather than later. Um, if it gets out beyond 3 years, that's the anything can change over the next 24, 36 months, and including pivoting and going a different direction. So, but if they list it, you know, 5 years out, then they're obviously going to need additional funding. So we look at some of the milestones that they hope to achieve uh, over the next 12 to 24 months. And things that they have to achieve in order to get to the next funding round.
Great. One of the valuable things, or one of the things that I think is most valuable about founders that have raised money from angel groups is it's it's almost as valuable to get the time and attention of some of the angels as it is to get their money. Um, just because of the domain experience and the diversity of insights and opinions. What type of mentoring exists for um, founders that apply to Park City Angels, and kind of what stage is that triggered?
Right. And I think that's one of the benefits of the founders coming to an angel group, whether it's Park City Angels or any group, is there is most likely somebody, multiple angels who have domain expertise in that area that the founder is focusing on. And so we had a founder a couple of months ago that was very early stage. He was um, marketing, selling energy bars, and he was really successful at it, but it was a one-man show, and he didn't know, you can only go so far about from selling that stuff out of your garage, and he had a full-time job, and so he wanted to go the next step, but he didn't know how. Well, were multiple Park City Angel that stepped in and helped him with his forecast, his business plan, uh, what he needs to achieve. And so in addition to the funding, they were able to help him out. And this is where we look to the founder to, if they're coachable, if they want to listen, that's a huge benefit. And we look for that because there's, nobody knows everything. And there's a lot of smart people in Park City Angels, and they're willing to help out. So mentoring is one of the things that we offer the founders.
One of the challenges for founders in fundraising is the timing of the investment. And I know that, there's things never move as quickly as the founder wants. And you just got to set expectations for a process, because that's the only way the angel groups maintain their sanity is to deal with the influx of applications and to screen that to a few folks they talk with, and then to have a screening meeting, a general meeting, and due diligence. Can you explain kind of the timing associated with that process?
Sure. So I'll use our example, our August meeting as an example. We have a general meeting coming up on the 15th. Well, we will close the applications into Gust, which is our platform for gathering information from all the companies, a good month prior. And people are asked, well, why would you do it, 30 days beforehand? Well, we get 60 plus minus companies that we have to review each month. And there's only, a handful of us, two of us really, that look through those 60. So we'll narrow those 60 down to 15. And so if it's, let's say, middle of July, we narrow that down to 15, and then we'll have a phone conversation with those 15, usually 15-minute call, not for a pitch, just to fill in some of the blanks that we couldn't get out of Gust or the pitch deck. We can ask questions, and then from those 15, we'll narrow it down to the top 5, which the following week after that, we'll have a screening meeting, and we usually have a dozen people on the Zoom call, and those 5 companies will actually pitch. And so it'll be, 20 minutes each, and they pitch for 10 minutes, and then we ask questions. And then after the 5 companies pitch, we will then discuss internally and pick the top 3 that we will have go to the general meeting. And, the top 3, usually it's they've checked most of the boxes that we're looking for. Because we look at 60 companies, we can usually take the cream of the crop, but we try to have some diversity too, between industries, between where the company, if it's in concept phase or they've been, have a good track record of generating revenue. There again, it satisfies the Park City Angels who may be looking for early entry, or they're a little more risk averse, such as myself, where I'm like, well, I want to get some traction, and maybe the return isn't as high, but there's a better chance of success. So anyway, so that after that screening meeting, then probably 2 weeks after that, 1 to 2 weeks will be the general meeting. And we have an in-person meeting every other month, and we strongly encourage those 3 that make it to the general meeting to physically pitch in person. we've seen a much higher success for the founders to get funded when they're actually at the meeting. So they're Park City's a beautiful place, so they're always looking for an excuse to come here anyway. Oh, and then I guess after that, once we identify, let's say the three companies go and they pitch, we ask who has an interest in these companies, and we don't go directly to due diligence. We have what we call a discovery phase, and so the week after, we'll usually spend an hour with the founder, and we're not asking them to pitch. We're just answering questions. So, people come to the meeting and they may not know anything about the company. And in 10 minutes, to be 20 minutes to say, oh yeah, I have an interest. I want to go to due diligence. That's taking a big leap. So we say, well, let's go through the discovery phase where we can ask questions. It's like, well, you don't have to commit to investing. You don't have to commit to due diligence. You can go and just listen to what other questions are being asked and ask questions yourself. And then from there, we ask who has an interest in going to due diligence. We usually, one of those people will lead the due diligence process, and we have a template and a process for that. And that could due diligence 45 to 90 days plus minus before they actually, get funded.
So a rational expectation applying to the angel group is probably minimum 60 days.
Yes, I would say at least 60 days. And yeah, that's there's hoops you have to jump through, but it's a risky business in angel investing. So you want to dot as many I's and cross as many T's as possible, and still there's no guarantees.
Talking about the pitch deck, I know that we've talked a lot about trying to guide folks towards giving us context, if you will. And we talk a lot about the ask slide internally, and coaching founders on pitching to an angel group is a little different than pitching to a VC. And you kind of want to set the expectations up front, and then kind of allow people to settle in on focusing on the high level deal terms, if you will, during Q&A. Do you want to talk a little bit about the ask slide and your thoughts on what is most valuable for kind of that summary slide at the beginning and the end of the presentation?
Yeah, it's so the first slide we request in the pitch deck. We typically say, okay, pitch deck, maybe 15 plus minus slides. But the first slide should just provide the basics. What is the ask? What's the valuation? What's the vehicle of raising funds? Is it a SAFE or a convertible note or a series raise? What's the use of the funds? What percentage of ownership is owned by the founder? Maybe some milestones, and also if they were referred by a Park City Angel or maybe a VC, if they've been funded by a VC, that helps a lot. Again, we look at a lot of companies, and so knowing that another angel has looked at them, put their eyes on them, and they've given it a thumbs up is very helpful. And so we suggest to have that in the first slide, and then after they go through all their pitch slides, when they go into discussion, go back to that first slide and just leave it up so people can see it.
That's really helpful. I really appreciate your time today. I think it's been incredibly valuable to allow some insight into what's going on with one of the most active angel groups in Utah. Do you have any additional thoughts or advice for founders that are either, kind of in general raising money at this early stage or applying to Park City Angels in particular?
Geez, Tim, there's so many things to cover, but I would say honesty, brutal honesty. If there is, if they say something that may or may not be true, or don't say something that should be mentioned. Let's say that they say they only have 2 competitors, and then we get to the due diligence and we find that there's 5 competitors. That's just an impact on the founder's integrity. And I don't want to invest in something where it makes me wonder, well, what else are they not telling us? So honesty, passion, and think about things questions that may come up. Let's say, for example, they've been in business for 4 years. Well, that seems a little long in the tooth for, looking for angel investments. So be prepared to answer that or mention it, to say, well, we started in 2019 pre-pandemic, and they had to close their doors for a bit because that had a severe impact, and now they're getting restarted. All right, well, that explains it. Because the thinking is, well, if they've been in business for 5 years and they haven't gotten a lot of traction yet, what is going to cause that hockey stick to happen in the next 1 to 2 years? So but there's a lot of things, and that's where, again, it's good to talk to angels. Park City Angels will help identify things that you should know, that will help them get the funding they need to be successful.
Thank you for that, Robert. I appreciate your time. And where can founders find Park City Angels online?
So there's they can go to the Park City Angels website.
And that's parkcityangels.com.
Yep, that's it. Thank you. And there's multiple tabs if they have an interest in presenting to Park City Angels. There is a tab for founders, and from there's a link to Gust, and they can enter all of their information in Gust. And I would highly recommend them to enter as much information as they can. There's multiple tabs. There's an overview. There's a finance tab. There's a business, an executive summary. And again, because we have to look at so many, if Gust is not completely filled out, we don't have the time to drill into documents they may have attached. We will look at their pitch deck, but if you've got financial projections, put those, fill in the executive summary. That is really helpful. And then that'll go into Gust, and we'll put them in the queue and look at it. And then, reach out to them if they meet the top 15. And certainly if they have a referral from a Park City Angel, they can also add that in Gust, and that'll get an extra look.
Solid insights. Thank you again, Robert. I greatly appreciate your time.
All right, great, Tim. Thank you for having me on the show.
You're welcome.